It is January the 6th, 2022. Happy New Year, everybody. It's a Thursday, and Keith and I are having our own Thursday evening insurrection, aren't we, Keith?
We are. We're totally insurrecting.
Sounds very vulgar, but it's the kind of thing we do in the Bay Area on a Thursday, on a rainy, cold Thursday evening. I'm going to Costa Rica tomorrow, where I hope the weather will be warmer and drier. So we're doing the show tonight. It's been quite a week, Keith. Not for January 6th. I don't want to talk about politics, but for tech, some really dramatic ups and downs. You're calling the newsletter this week Tech Crunch. I wonder where you got that word from.
Yeah, I noticed that when I published it, somebody in Florida immediately started reading it. I wonder who that was.
Yeah, well, you made up the name, didn't you? That's what I heard.
I didn't actually. That isn't true. It
Let's not
definitely isn't
open
true.
that
But
can of worms.
but I am completely responsible for Michael Arrington's existence. That's true.
Yeah, without you, he wouldn't even be alive. So, what happened this week, Keith? Lots of dramatic ups and downs, swings on the tech front, and
Yeah.
some serious evaluations and reevaluations of big tech companies.
Yeah, I mean, for those who don't pay attention to the stock market, and it's easy not to, it's been very dramatic, actually. The tech stocks have crashed, some of them by, like Salesforce has crashed 30% in a week.
30%?
Yeah, and that's normal. That's typical. And this graph on the front cover of this week's newsletter, this is Catherine Wood's ETF, exchange traded fund, called the Innovation ETF. And CNBC today reported at one point it was minus 48% from its high.
Yeah, but she's been riding high. She deserves it, doesn't she?
Well, let's not personalize it to her, but the basket of companies in this specific ETF is good companies. I mean, it's full of the best companies, the most likely growth companies. And her point is that if you're an investor, you should buy growth. Now, what's been happening is in the public markets, growth has been valued at a very high multiple of revenues. So if you're growing at 200% a year, the market was prepared to pay, sometimes well over 50 times revenue. The average was probably around 25 times.
You're a good long-term thinker, Keith, in historic and economic terms. I mean, is this mini crisis at the beginning of 2022, does it have any significance? Do you think by this time next year, are we going to be talking about the decline of tech stock?
I don't think so. I think it's. I think the markets and the real world are disconnected. The markets are driven by speculation. So the accusation pointed at Web3 is it's full of speculation. Well, that couldn't be more true of the public markets. They are a gambling game, basically.
And there's so much uncertainty because of COVID and because of the Biden infrastructure plan, and because of inflation and interest rates, that I'm guessing that tech stock, in a sense, are innocent bystanders here.
Yeah, it's a contrarian signal, actually. The fact that these tech stocks are declining is not a signal that there's something wrong with them. It's a signal.
Yeah, Salesforce of all. And yet at the same time, this was the week that Apple got valued at $3 trillion. So some stock is up.
Actually, that's the paradox. The FANG stocks, apart from Amazon, up during the last 12 months, up not quite 100% in most cases, but getting above 50%, and have not corrected as much as some of the more recent IPO stocks. So this is really a punishment for being recently public. If you look at the basket, and those companies are the ones with the most growth. If you look at Lucid or Rivian or Cloudflare is about down 50% from its peak, and Cloudflare is a great company, and is going to get greater still. So it's a
great time to be buying stock.
I think if you are liquid enough to buy stocks, there's some bargains to be had right now. I agree, and maybe including Catherine Wood's ARK Innovation Fund, which is down significantly, and I can't believe it will stay there. So yeah. Now, interestingly enough, this is one of our tweets of the week, but I'll show it now. The key here is really the disconnect between the public and the private markets, because whereas the public markets have been correcting, the private markets haven't, which is what Josh Ullman, who of course used to be a Greylock, and before that is a well-known social media engineer. He's got a great career history. And he makes the point that my wife Jenny makes in her article this week about 2021, just how amazingly rapid growth is being experienced in the private markets. There are now 1,148 private unicorns on the Crunchbase list.
But there's going to be, is Janae our new Paul Graham? We can't have a show without mentioning Janae. Do you get something in exchange for dropping her name?
I don't think you get anything. I might get lucky.
You may get lucky. Well, it's lucky that neither of us have wives at senior roles at big tech companies, because then we'd be in a particularly bad mood, right?
We wouldn't be able to talk about, Crunchbase, PayPal, or any of those other companies.
Exactly. So what's Janae's point? That the private market, isn't it a bit slow? And doesn't it just take more time to impact on the private market?
Well, look, this is this week's company of the week, startup of the week. OpenSea, which is only less than a year in the public awareness. It has a longer history since its formation, but it's now valued at $13 billion. And it was, well under $50 million a year ago.
Okay, no, I take your point, but let's use Apple as an example. You said, well, Apple's different, but people are betting on Apple as a car company now. I think that's one of the main reasons why it got to the $3 trillion mark. And private companies, you are betting much more on the future. I mean, everyone knows what Salesforce is. It's a very good company, but it's not about to reinvent itself. It will just continue to do what it does very well. The same of many other big tech companies. But Apple seems relentlessly able to invent and reinvent itself and take over entirely new businesses. And the car business is obviously a really interesting one. So isn't it more the types of companies than the public-private split?
I actually don't think so. I tell you what I think it is. There's a mathematical formula that is common to both, and they all get measured by. And it creates an apples to apples comparison. And that mathematical formula
was that an intentional joke, Keith? Pun? Apples to apples?
It was totally unintentional. I'm definitely not clever enough to have thought that up ahead of time. And anyway, the common formula is current revenue multiplied by rate of growth as a function of total market available. So if you have a big market available and you have a lot of revenue and your rate of growth is 100% a year or 200% a year or 300% a year, and you've achieved a certain market penetration, 1%, 2%, 3%, 4%, all companies are kind of measured the same. And the reason private companies are valued at a higher multiple of their revenue is their rate of growth is bigger, their total market is bigger, and their current penetration of the market is smaller. So the total upside by buying today over 10 years is huge compared to, say, an Apple, where Apple's already huge. It's penetrated its market, significantly. And in order to grow, it has to create new products and new markets, which it will do. But you're betting on that. So it trades at a much lower multiple of its revenues than, let's say, a startup does that's still private. And so there is a logic to how these companies are valued based on common mathematical formulas. And then you decide what today's value is based on that potential. And I think the public markets are basically, they're getting companies that have already matured. So the likely growth rate is lower, whereas private markets, they haven't matured and the growth rate is higher. As a result of that, for the last 10 years, most growth in value has happened in private companies.
And that, I think, suggests why the M&A market is so critical for public tech companies, because the only way Salesforce can reinvent itself now is by acquiring. I mean, who did they just acquire? Who did they just acquire? The big acquisition.
They acquired Slack.
Yeah. Which maybe they don't want to acquire companies in their own sector.
Well, they that wouldn't help them. They are basically the operating system for an enterprise, centered on sales and then customer service, and they're kind of expanding into adjacent areas through acquisition.
And then there's Microsoft, of course, who seem to make terrible acquisitions continually and then grow in value. I don't quite understand them. How would you explain Microsoft?
Well, Microsoft's growth rate's been really good since they focused on the cloud, and focused away from Windows and Office to the cloud. Their rate of growth is very impressive, and their stock is one of the best performers of 2021. Actually.
Yeah, I mean, it's worth $2 trillion.
Yeah.
Well, and the creator economy, you've been touting the creator economy for a while. I was a bit more skeptical, but the creator economy really seems in this first week of 2022 to be hot.
Yeah, there's a lot going on. You sent me this article about fan-centric accounting, which is going to bring more money to artists. Another way of thinking.
That's a theme you've been going on about.
Yeah, and I think it's that's a lot to do with ticketing and events. I think ticketing at events is low-hanging fruit. LinkedIn today announced that they're going to be copying the Clubhouse tech, but will not yet support ticketing and events. And they felt the need to point that out because they realized that's going to be a big revenue stream in that space. The other thing is The Information reported that, as they predicted back in October, that there'd be $5 billion of investments in the creator economy this year, that it's actually happened. And they launched this really actually quite useful database of all the companies that raised that money and at what valuation and so on and so forth. And who the leading
where do you think the creator economy is hottest? What is it according to The Information? One of the news stories earlier this week that I was intrigued with is this collaboration between the two Smiths on creating a new television network to take on CNN and the BBC.
Yeah, I think the creator economy, the definition is going to be expanded to include lots of things. It's really when professionals and amateurs together can use tools to produce content and get an audience. And I think
which isn't very original. I mean, wasn't that Web 2.0?
Web 2.0 was, the first step. I think now with latency-free streaming and interactive audio and video, the imagination can go crazy with what you can make that broadcast could never have done.
So here's a two-part question, Keith. I know you're going to get the first one right. Second one, I actually don't know the answer to, and you're going to guess. Who invented the term Web 2.0, and when did this person invent it? What year?
It was Tim O'Reilly.
Right.
And I'm going to guess the year, but I'm going to guess it was 1996.
No, that's
sorry. I mean, I don't mean that. I mean 2006.
No, that's completely wrong as well. I'm guessing 2003 or 2004.
Well, when TechCrunch was born, it was 2005.
Yeah, and I wrote Cult of the Amateur in 2000. Well, it came out in 2007. I researched it in 2005 and 6, and I went after O'Reilly then for the Web 2.0. It was already established by then. I'm guessing 2000. My guess would be 2003. No way, it's 2006.
Could be John Battelle. Was it John Battelle or Tim O'Reilly?
O'Reilly. I think O'Reilly.
They hired Battelle.
Yeah,
Battelle.
I mean, well, I'm going to look it up on my favorite site, Wikipedia, as we talk. But the reason, of course, that I set you up on that, Keith, is because Tim O'Reilly has a really interesting, wonderful piece, very rich and thoughtful about Web3. And unlike most people, he actually has the credibility and the right to write about Web3.
Yeah, actually, this piece is a couple of weeks old. It came out as we published last week, and I
A
didn't get a
really
chance
great
to.
piece. If anyone reads anything from this week, apart, of course, from Genèse, which we have to read, they need to read O'Reilly's piece on Web3. It's really meaty, full of really interesting
Yeah.
insights.
Well, basically, that was the week as a curation platform. And just like the Louvre Art Gallery in Paris, we tried to curate the best artists, and Tim is one of them. By the way, he's a
Isn't it an
reader.
NFT? Are we an NFT or are we an actual gallery?
We're an actual gallery.
So when I put Web 2.0 in, the first thing that came up is Chelsea 2, Tottenham 0. I don't know why.
That's because you put 2 and O. and Google knows you're a Tottenham fan.
Okay, so we both got it completely wrong. The term was coined by Darcy DiNucci in 1999 and later popularized by Tim O'Reilly and Dale Doherty at the first O'Reilly Media Web 2.0 conference in late 2004.
There you go.
Interesting.
Yeah, we were close on the second one.
Anyway, so what does Tim say about Web 3?
What Tim says is that Web 3 has yet to glue together its promise with any real world applications or use cases, and therefore is largely driven by speculation in tokens, not by actual code driving actual experiences.
Here's a really dumb question, Keith, and I'm going to make a complete fool of myself as I always do on this show. Why is an NFT so Web3? What is it about NFTs that make them Web3? Is it because they're protected on the blockchain?
Yeah, I mean, NFTs could have been invented prior to blockchain.
The idea of them doesn't seem very Web3.
Well, so the core idea is to be able to identify a single instance of a digital artifact as being the valid one, which is
the first mover, the first one, the original.
Yeah. So it's kind of a certification. And then through the certification, the owner of the certificate becomes the owner of the digital artifact, no matter where it is. And so that could have been done in a centralized way easily.
Yeah, I mean, in a sense, it's a Web 1.0 idea of original ownership and you pay for it. But I guess in that sense, it's easy to confuse blockchain and Web 3. They're separate, and not every application of blockchain is a Web 3.
Well, actually, I think I wouldn't necessarily agree with that. I would say, so let's go back to your actual question. The question is answered by saying this. Web 3 is about trustless and distributed infrastructure.
It's about truth. O'Reilly quotes someone else saying that trust is replaced by truth in Web 3.
Right.
And the blockchain is truthful. You can't fiddle with it. It's not a question of trusting it.
Well, the only way to fiddle with it is to gain more than 50% control. And if you can do that, you can reverse transactions that have already been done. But unless you can get 50+% control, the ledger remains intact as evidence for what has happened.
Yeah.
And so NFTs are on a ledger and are the truth of what has happened.
Okay. Well, anyway, I'm sorry I distracted you. Let's go back to what Tim says about Web3. What's its potential, and why is he concerned about its reality?
So the first thing is, let's just say at the outset, he is a little bit cynical, but he validates his cynicism. He says that he's seen swings between centralization and decentralization more than once, and he gives some examples of that. And he makes the point that the pendulum always swings back from where it currently is. So the
Yeah,
first
and
thing is,
he was very nice. A lot of people went after him on Web 2.0, including myself, for his idealism. And to be fair to him, he has been very public in acknowledging the mistakes he made about Web 2.0. And he's a very generous kind of guy and being
yeah.
willing to talk to obnoxious people like myself.
What mistakes did he make, though? I don't remember any
Well,
big
he
mistakes.
embraced the whole thing. I mean, he was the one driving the idea of everyone becoming a creator and the long tail and the rest of it.
But why is that a mistake? I mean, in a way, you're an example of it. I am. Michael Harrington is,
Well, that's another debate. Read my books. Anyway, let's not get back into that. Let's talk about Tim and Web3.
Yeah. So here's the core of it. He says, blockchain developers believe that this time they've found a structural answer to re-centralization, but he doubts it. And he asked the question what the next focus or locus for centralization and control might be.
Yeah, and that's something that I think he's nailed it, as he often does, because someone still, I mean, it's still going to have, I mean, you can call them DAOs or whatever you want to call them, but as you say, the private markets are hot, and you're still going to have people who own these things. They may not use that word own, but they will own it, just like they own Bitcoin.
Well, yeah, they'll own value on networks via token ownership is what they'll do.
Right. Okay, so they'll have tokens, which
Yeah.
aren't stocks or shares or cash, but they're still financial value and power.
Yeah, well, ultimately, the blockchain is a value-based network, and those that put the most in get the most out. So if you have the resources to put a lot in, you'll get a lot out. So
Yeah, but that's Tim's point in his essay, is that it's only the powerful who can put a lot in, and they're the ones who benefit, the Andreessens of the world, who we talked about last week. And the whole point of Web3 from the point of view of a progressive is like Tim O'Reilly, is to empower people who don't have Andreessen's financial might.
yeah, so that is basically he makes a point prior to that. His first and I think his most important point is the failure to think through and build interfaces to existing legal and commercial mechanisms. So basically, there really isn't any real world uses happening. Now, he's a little bit wrong, because I think distributed finance, and especially interest bearing stable coins, is a use case, and banking is is going to be impacted by that. So he's not wrong, but there is evidence that it's trending away from his point. He then goes on to really drill down into that.
Oh, he agrees with me. It's not clear that NFTs fit the bill. I couldn't agree more with that.
Yeah. And then finally, he makes the point that there is so much yet to be created. And let's focus on the parts of the Web3 vision that aren't about easy riches, on solving hard problems in trust, identity, and decentralized finance.
Yeah, and he quotes Matt Iglesias talking about housing inequality, when Iglesias writes, a society becomes wealthy over time by accumulating a stock of long-lasting capital goods. And that's the challenge for Web3, is not to re-centralize everything in the hands of Mark Andreessen and Ben Horowitz.
Yeah. Now, if you think about it, it's interesting. I personally, and we've talked about this a lot on That Was the Week, I personally believe that technology and automation end up reducing human labor, price down to close to zero, and enable something like a universal basic income for everyone in the world.
But I mean, we've had this conversation before. You may be right in the very, very long term, but neither of us are going to be around to know that.
I know, but that's a preface to me. It's a philosophical preface to, does blockchain and Web3 contribute to that or against it? And there isn't an easy answer, actually. It could easily be against it.
I think the jury's still out about whether there really even is such a thing as Web3, and whether blockchain is just one piece of technology. And the other thing about Tim's essay, which I really liked, he brings up very brilliant historian of technology, Carlotta Perez, who's very much in vogue now. She's a historian of tech booms and busts and infrastructure and investment. And he really uses Perez to make sense of booms and say that even in the busts, there's still meaningful investment. And ultimately, I think his suggestion is that irrespective of the fortunes lost and gained in Bitcoin, in the longer term, there is Web3 infrastructure being built that will change the world. It's just going to take longer than 2022 for this to happen.
And it has to be done in such a way to prevent, the rich getting richer and the poor getting poorer. It's going back to the venture capital stuff at the top of the show. Private companies are not available to be invested in by normal people, except through their pension funds, maybe.
Well, we've had this conversation before. I mean, I agree in a way. I just don't know. Well, I guess it could work, but it's going to take a lot more, and it lends itself to bubbles. Anyway, in the long term, Keith, as we've joked, well, not you and I have joked, but Keynes joked, we're dead. But hopefully, neither of us will die in 2022. And you have one or two more predictions. We did predictions last week, but you have a couple of leftover predictions for the year.
Well, this is me kind of cleaning up stuff that came out after the year had turned. Benedict Evans actually agrees with a lot of what we said, but it's well worth reading him. Scott Galloway has a whole bunch of predictions.
What does he say?
He really doesn't say anything interesting, so I'm not going to take our time away.
I think the thing with Galloway, that I like him, and he's very smart. He's a brilliant public speaker, but I think he's on very thin ice when he's told the world that he wants to be the next Peter Drucker. It's unwise to say that.
Yeah, it's like me saying I want to be the next Warren
Jeff
Buffett.
Bezos.
Oh, I don't want to be Jeff Bezos. Warren Buffett, maybe. Anyway, then you've also got Azim Azar, who's well known to us UKites as a
and he's been on my he's the exponential guy. He was on my TechCrunch on my Lit Hub Keynon show. He's very good and very smart and nice guy.
And Fred Wilson, who looked back at his predictions from the previous year to see what he got right and what he got wrong, and made a small number of predictions for the year ahead. And so let's not go into what they said, but they're all worth clicking through and reading. They're all smart people.
Yeah, well, it's going to be an interesting year, 2022, I think, for tech. It's already been an interesting year. We are just 6 days in. Keith, what is our startup of the week? It's not going to be startup of the year. We already talked about them.
We already talked about it. It's OpenSea, and they are the NFT company. Basically, they're the big winners from the whole NFT thing. They are centralized.
And what do? They store
they
have the blockchain for the NFTs.
They link to the blockchain. They secure wallets for buyers and sellers. They let you upload and sell, a bit like an eBay for NFTs, if you like.
So they're selling the Levi's to the gold diggers in the NFT world.
They're the middlemen who
and they're always the ones who make the money.
I don't
know, in the tulip craze, who were the people, the equivalent of Levi? Were they the growers?
Probably the wholesalers.
Yeah, or the people who had the suits where you could put a tulip in the buttonhole.
Exactly, distribution.
Yeah, well, I think NFT is, to put it politely, frothy at best, but that's another question. So they're your startup. Are you saying they're startup of the week because they're good or bad? Because they're frothy or real?
I think both. They're frothy and real. It's a good example of how value is being driven in private. If you think about the growth from them being worth 50 million to 13 billion, happens in 12 months, and ownership is only available to large venture capitalists or private equity investors. And by the time it does an IPO, it's going to be valued at the top, and there'll be no more growth by the time, Joe Blogg can buy stocks and shares in it.
Yeah, I still don't buy that, because Joe Bloggs doesn't have the money or the time to invest
Well,
in early stage NFTs or early stage
well,
crypto or blockchain
imagine.
companies.
I'll give you a scenario. Robinhood, the app,
Yeah.
lets my sons buy fractional shares in any company they want, or any crypto, by the way.
I think generationally, I think in demographic terms, but they're your sons. They're not Joe Bloggs' sons. They're boys living in Palo Alto surrounded by other boys, and they probably spend half their time talking about crypto.
Well, Robinhood has brought on 20 million stock buyers in the last few years.
And I think that is, and we will maybe talk about it another week. I think that it's one of the reasons for the irrational exuberance generally in our economy are these people on Robinhood, kids.
So I know the answer to this, but I'm going to wind you up anyway. So you think that only intelligent people should be able to buy stocks and shares in private companies?
No, I didn't say that. I think only people over 40. Don't you think? I mean, you're not allowed to drive until you're 16. You're not allowed to get married till you're 16, or fight in the army. I think you should own or vote. You shouldn't be allowed to buy shares until you're over 30. How about that?
It's the
Drinking. You can't even drink in America till you're 21. You can buy how old do you have to be to buy shares?
you have to be able to open an account. I think it's 18.
Do you allow women to buy shares?
They do indeed. But if you actually, to be serious for 1 minute, that whole
I am
tradition,
serious.
that whole tradition of thinking that starts with Plato, or probably even before Plato, about the cultural elite. He called them philosopher kings. The cultural elite should be given greater rights in society than the proles, because you can't trust the proles to do the right thing and then mess it all up, is the core of authoritarianism. And it's interesting, but it is no one would compare Plato, let's say, to Hitler, but they are kind of closely associated in their worldview.
Well, there's lots of books on that, and looking at China or Singapore, there's
Yeah.
certainly a close connection between authoritarianism and technocracy. But that, and then subject maybe for another show or another week. Finally, Keith, we've done our startup of the week, which is an NFT platform. What's the tweet of the week?
So the tweet of the week is the performance of venture capital funds versus the S&P 500, which is basically small and medium businesses in the United States. That graph on the far right with a square around it is 30 years performance, and the dark color is venture capital and the light color is the S&P 500. On the other end, the graph is this year. And what it shows is that people who can invest in private companies through venture capital basically have always done better than people who have to invest in index funds like the S&P 500. So it's another depiction of how centralization of money creates centralization of wealth.
So what you're saying, and so how does your startup change that? You're just piling in, you're just compounding this inequality.
So we're I don't know if I really should answer that, but I will, because it's interesting. But what we're doing is we are raising capital, so are quite centralized initially, in order to put money into seed stage startups, actually at the B round stage.
Well, you're not
So,
empowering Joe Blogs.
no,
You're
well,
just
wait.
providing liquidity to
No, well,
early stage investors.
let me explain the 3 steps to heaven. Step 1, raise $1 billion and put it into the best companies. I want to explain how. Step 2, take that entity public and list it. Step 3, take the profits from the first cohort and reinvest them over and over again in new cohorts whilst your shares are available to the general public. By step 3, every new investment you make can be shared in by everyone.
So you are the new Warren Buffett, Keith.
Robinhood for private companies.
Wow. Wow. Is anyone, for our massive audience, can they invest in what you're doing? You taking investments?
No, not yet. you know, phase one is traditional, as in we're going to be raising money from people who are qualified to invest in private companies by government rules, and we're going to be regulated as a fund by the SEC, so we have to play by the rules. Only once we're public in stage three does it become opened up, and at that point, for decades and decades in the future, private company wealth growth will be available to normal people.
And meanwhile, I'm unpaid for this. I have no equity in what you're doing. So what am I doing here?
Well, this is a totally different universe called That Was the Week that we love to live in, once a week at least.
That was the week for January the 6th, 2022. It's been a much better January 6th than it was in 2021. And I hope, Keith, that the year will continue to improve for all our audience and for you and I. I don't think we're good. I'm not going to be back next week because I'm in Costa Rica. You might do the show on your own or find a replacement, but we'll see you in a couple of weeks. So keep well, everyone, and best of luck with all your investments and ventures.
Yeah, I think we might do Jeanette Tier and Paul Graham next week just for fun.
Just the two of them together, you would explode.
I know.